Inheritance tax in the UK. What you need to know. 1. Background and why it matters. Inheritance tax, IHT, is charged at 40% on estates valued above the nil rate band of £325,000, plus a residence nil rate band of £175,000, with various exemptions like transfers between spouses. Despite a headline rate of 40%, the effective rate averages about 13% due to exemptions and reliefs. 2. Major reforms ahead. A. Capping business and agricultural relief from April 2026. Previously, farms and family businesses qualified for 100% relief, regardless of value. Under new rules, only the first £1 million of such assets will get full relief. Anything above that receives only 50% relief, leading to an effective 20% IHT rate on the surplus. These rules will also apply to trusts, possibly shared between multiple trusts of the same settlor. Owners can pay IHT in interest-free installments over 10 years. B. Shift to a residence-based system from April 2025. The UK will move from a domicile-based to a residence-based IHT system. Individuals residing in the UK for 10 out of the last 20 years will have their worldwide assets subject to UK IHT. If such a long-term resident leaves the UK, they may still face IHT on overseas assets for up to 10 years. C. Pensions become taxable from April 2027. Unused pension funds and death benefits, previously exempt, will now be included in estate value for IHT purposes. This could push more estates over the threshold and tax them at up to 40%. An estimated 10,500 estates may be newly affected, and around 38,500 more may face higher liabilities, generating £1.5 billion annually by 2029-30. D. Frozen thresholds and expanded scope. Both nil rate bands, £325,000 and £175,000, are frozen until 2029-30. As asset values rise, more states will exceed these thresholds. 3. Current trends and public reaction. A. More estates paying IHT. 31,500 estates paid IHT in 2022-23, a 13% increase, and this is expected to climb to 9.5% of all estates by decade's end as reforms take hold. B. HMRC enforcement intensifies. HMRC launched 3,961 investigations in 2024-25, up 41% from the prior year. Executors now face high stakes, with interest on overdue tax at 8.25%. C. Surge in tax planning activity. Advisors report a spike in inquiries, with tactics like discretionary trusts, offshore investment bonds, family investment companies, whole-of-life insurance, gifting strategies, and holding UK gilts gaining traction. D. Farmers and protest. The tractor tax. Farmers have staged mass protests since November 2024, dubbed the tractor tax, due to concerns over tax triggers on family farms. The government counters that with exemptions and careful planning, up to £3 million per couple might still be passed down tax-free. E. Calls for further reform. The government is considering additional reforms, such as capping tax-free gifts to plug a £50 billion deficit, potentially reshaping gifting rules and taper exemptions. 4. What this means for you and key takeaways. Issue. Insight. Estate planning urgency. Now is a critical time to revisit wills, trusts, pensions, and gifting to adapt to changing rules. Pension inclusions. Consider how unused pensions will factor into IHT and explore potential mitigation strategies. Complex asset relief. Farms and businesses may be significantly impacted. Familiarize yourself with caps and phased relief rates. Compliance is key. With increased HMRC scrutiny, accurate records and valuation transparency are essential. Use of financial tools. Instruments like onshore bonds, trusts, and gifting remain viable if structured wisely. Watch lifelines. Some rules, e.g., APR/BPR reliefs, may allow leveraging existing allowances before deadlines April 2026, 2027. Inheritance tax reform in the UK is reshaping the landscape for families, farmers, and wealth holders alike. Whether navigating frozen thresholds, broader tax scopes, or relief caps, the key is proactive planning before the rules tighten further.